How to calculate two stocks portfolio with risks and return without probability case under Sharpe Index Model. We will learn in this video. So let's get started. Okay, so here in these questions we can see that there are two stocks, that is stock A and stock B, having some certain rate of return in percentage in a particular state of economy or period. Okay, we have also the rate of return of the market, and here we have the investment weight for the stock as a 40% and 60%. Okay, based on these questions, let's calculate the portfolio risk and return by using this model. Okay, all right. Okay, here we have 9 steps, followed by preparing the computation table, identification of investment weight for stocks, calculation of number of periods or observation, individual risk and return of stock, calculation of covariance and correlation coefficient value of stock with market, individual beta coefficient of stock, portfolio beta coefficient of stock, portfolio risk and return of stock, and conclusion and decision. Okay, now you can see that I have partially done with the 2 steps, which are nothing but it's a question part, that is this one and this one. Okay, now let's calculate the computation table or computation part of this step based on the heading of the column, right? So let's calculate first this column, okay, by using this formula. Okay, so press the equal to sign or press the open parenthesis. Now click here, minus, click here, now press the F4 key to absolute reference, now press the close parenthesis, now press the power sign from your keyboard, now press the value 2, now press the enter key. Alright, now click here and drag from here to here. Alright, now for this column we can calculate the same as earlier. Okay, so let's calculate it quickly first. Okay, alright, now let's go to the step number 3, that is here. Okay, and now let's calculate the number of period or observation by using the counter function in Excel. So press the equal to sign, type counter, now press the tab and select the range from here to here. Now press the F4 key to absolute reference, now press the close parenthesis, now press the enter key. Okay, now let's calculate the individual risk and return of a stock based on the following statistical measures one by one. So first let's calculate the expected or average rate of return. Okay, and it can be calculated by simply adding the rate of return of a particular stock or market and dividing by the number of periods. Okay, so let's calculate it. So press the click here, now press the equal to sign and now type the sum function here and select the range from here to here. Now press the close parenthesis, now press the divide sign from your keyboard and now click here, and now press the F4 key to absolute reference, now press the enter key. Alright, now click here and drag from left to right. Okay, second, variance can be calculated by taking the value from the computation table and dividing by the number of periods. Okay, so press the equal to sign and let's select this one to get the variance of the market, right? Press the divide sign from your keyboard and now click here, and now press the F4 key to absolute reference, now press the enter key. Alright, now click here and drag from here to here. Okay, third, the standard deviation can be calculated by simply applying the square root to the variance value. Okay, so press the equal to sign, type the sqrt function. Okay, and now click here to select this value, now press the close parenthesis, now press the enter key. Okay, now click here and drag from left to right. Okay, for coefficient of variance can be calculated by simply dividing the value of a standard deviation by the value of expected rate of return, that is this one. Okay, so press the equal to sign, now click here and now press the divide sign and click here, now press the enter key. Alright, now click here and drag from left to right here. Okay, now let's calculate covariance and correlation coefficient value of stock with market. Okay, so under this step we have to calculate 2 covariance and 2 correlation value. Okay, so first let's calculate the covariance of stock A and market, and it can be calculated by simply taking the value from the computation table and dividing by the number of periods. Okay, so click here, now press the equal to sign, and now let's go back here and click here. Now press the divide sign from your keyboard and now click here. Now press the F4 key, now press the enter key. Okay, now for covariance of stock B and market, it can be calculated by the same as earlier. Okay, so press the equal to sign. Let's go back here, and at this time select this one, and now press the divide sign from your keyboard and now select this one, and now press the F4 key to absolute reference. Now press the enter key. Alright, now for correlation between the stock A and market, it can be calculated by simply dividing the covariance value by the product of standard deviation of stock A and standard deviation of the market. Okay, so press the equal to sign. Now click here, press the divide sign from your keyboard, and now press the open parenthesis and select this one times this one. Now press the close parenthesis. Now press the enter key. Alright, similarly for correlation between the stock B and market, it can be calculated the same as earlier. So press the equal to sign. Now select this one, press the divide sign from your keyboard. Now press the open parenthesis. Now select this one times this one, and now press the close parenthesis. Now press the enter key. Alright, now let's calculate the individual beta coefficient of stock, and it can be calculated by simply dividing the covariance value by the market variance. Okay, so for beta coefficient of stock A, let's calculate it. So press the equal to sign, select this one, divide by this one. Now press the enter key. Alright, similarly for beta of stock B, press the equal to sign, click here, divide by this one. Now press the enter key. Alright, now let's calculate the portfolio beta coefficient of stock, and it can be calculated by simply adding the weighted beta coefficient of the stock, while the beta coefficient is the product of the beta coefficient and weight of the stock. Okay, so press the equal to sign and let's calculate it. Press the equal to sign. Now click here, times, click here, plus, click here, times, click here. Now press the enter key. Alright, now let's calculate the portfolio risk and return of the stock. So first, portfolio expected return, that can be calculated by simply adding the weighted rate of return of stock A and the weighted rate of return of stock B. Okay, so click here, now press the equal to sign, and now let's select this one times this one plus this one times this one, and now press the enter key. Alright, second, portfolio expected risk, and it can be calculated by using the formula displayed on the right side of this sheet. Okay, so I'm going to use this formula and show you the final value. Okay, alright, now the final step is conclusion and decision. Under this step, we can see that our decision board is showing that stock A is favorable due to low beta as compared to B. You can see that the beta of stock A is less than the beta of stock B. Okay, that's why our decision statement going like this. And let me tell you one thing, I have made this decision board automated by using the if function. You can see in the formula bar. Let me show you this by zooming in. You can see I have used the if functions. Okay, now press the enter key. We are done. So guys, that's all for now. If you find it useful, please hit the like button and don't forget to subscribe to this channel. See you in the next video. Signing off.